Well, hi, everyone. Thank you for joining us for today's webinar. Throughout the presentation, if you have any questions, please feel free to type them into the question box. Should be over on your right-hand side inside the GoToWebinar app or control panel. You can type those in at any time, and we'll cover them after the presentation. We've also done several audio checks to make sure that we sound good and don't sound too echoey. But if you can't hear us, you can first try dialing in using your phone. There will be a little dial-in number on the right-hand side you can find, or let us know through the question box if the audio seems to be really bad, and maybe there's something we could do on our end. We'll also be recording today's webinar. We're most excited about that. We have several people that couldn't make it today. Seeing as we're in the middle of December, I'm not surprised, and we're excited to be able to view this and watch it later. But thank you so much to those that are live on the call. Okay, great. Let's start. Today we'll be sharing the details of our recession-resistant real estate fund. My name is Ryan Andrews, and my partner Mark Curry is presenting along with me. You'll actually get to hear quite a bit from both of us today, and we're thrilled to be sharing this investment opportunity with you. We've been working on this fund for about a year now, and the strategy consists of combining our favorite assets into a fund for passive investors. The fund is designed to continue to perform, and by that what we mean is continue to generate consistent and predictable cash flow through a recession or a financial crisis. Before we dive into the details, we'd like to give everyone a quick status update on our fund. We launched about 45 days ago and are already off to a really great start. We've had over $1 million invested into the fund, and we still have some room left in our founder shares, which we'll review a little bit more later, in more detail later. We do anticipate seeing the founder shares to fill up quickly following this webinar. So if you're considering an investment, the next steps are to reach out to us with any additional questions, and we're also happy to share with you our PPM and subscription agreements on the rest of the paperwork. We just wired funds for our first apartment investment on Friday of last week, where we hold an equity ownership position in an off-market 284-unit apartment community in Austin, Texas. Austin is one of the fastest growing markets in the country. This is a picture of the actual apartment community here on the slide, and it's already producing positive cash flow that meets our yield targets and is 94% occupied with a strong value add opportunity. This property is going to be renovated, and the majority of the units turned over and rents are going to be raised. We'll provide further details on this investment later in the presentation. In addition, we're in the final stages of due diligence on 2 additional investments. The first is a portfolio of 8 mobile home park properties located in Nevada, North Carolina, and Oregon. The second is a portfolio of mobile home parks and self-storage facilities consisting of 16 properties across 6 states and totaling over 6,000 units. We're very excited about these opportunities. They provide us immediate diversification geographically and an equity ownership across each asset class. In addition to the Austin, Texas apartment community, we're also planning to invest in these portfolios before year end. And so we are actively taking investor commitments now and are able to put the money to work right away. I'd now like to introduce my partner, whom some of you know, Mark Curry, to share about his background and experience.
Thanks, Ryan, and hello, everyone. Thanks again for hopping on the webinar today. We know it's a busy time for everyone with holidays coming up, and appreciate you joining us. I'm happy to share my background for those of you that don't know me. I began investing, in real estate about 14 years ago now. I remember my first deal. It was actually buying a condo in Glendale, California. It was a probate sale at the courthouse, and so I really got my first taste of real estate with a distressed property, and I've been hooked pretty much ever since. I've done several more deals, after that initial deal, while maintaining a full-time corporate finance job. And really what that meant was running to Home Depot at night after work and managing properties and tenants, really very hands-on. I also pulled together the capital for some of those first few projects through lines of credit, really with the goal of growing my personal portfolio, one at a time. Along the way, I never really bought a turnkey property. From the beginning, I've been very focused on value add and renovations rather than just relying on natural market appreciation. And I started partnering with others again to grow our portfolio and to be able to do more deals. And first, it was with my brother, and then with some other family members, and eventually outside investors. By about 2009, after the market crash, we saw some really amazing rentals that were up for auction. And expanding on our partnership strategy, my family and I pooled some money together, and we started buying up value add properties that we renovated and held onto as rentals. At that point, I had really decided I wanted to shift careers, and I left corporate America and I dove into real estate investing full time. For those of you that don't know, my father is a retired orthopedic surgeon. He's also been a longtime real estate investor since the 70s. And we had done several projects together at this point. And we decided, to really get together and make something bigger. And we partnered and opened up SMK Capital Management with the goal of providing value add passive investment opportunities to our friends and family. So after starting our business, we really just needed to raise some capital. And so we proceeded with our first official capital raise outside of our family, where we presented our business plan to over 50 of our close friends and family in our basement of our home. We provided food and drinks, of course, to make sure people showed up. And we were projecting at the time, I think we were trying to raise, roughly 4 million. I believe we ended up with around 400,000. So we fell quite short of our goal. But these humbling beginnings, are really what shaped the principles that we adhere to today. Our internal values have developed from our closest friends and family, entrusting us to manage their capital. And that's something we take very seriously. We pride ourselves on transparency, and honesty in everything that we do. And I'm proud to say that a lot of those first few investors from our basement pitch are still actively investing with us today. Along the way, I became a licensed California real estate broker. I didn't enjoy the transactional side of the business, but really fell further in love with the real estate investing. And one thing that we learned along the way is that things don't always go as planned. Changes happen, and the true test of a great investment, always starts with the people involved and their ability to react to changes that come up, changes in the business plan, changes in the marketplace, etc. So I want to give you all a quick example of things not going to plan on one of our rental properties and how we handled it. So you can see on the screen here what we call a total loss from a fire. And this was in the fall of 2013. I got a call from my property manager in Florida regarding a duplex that our partners and I were holding rented as part of a portfolio. And my property manager said, "Hey, Mark, we've had a fire." And I actually thought he was joking. I didn't sense the tone being anything other than comical. But within a few very quick seconds, it became very clear that he was dead serious. He told me, "Hey, Mark, it's not a small fire. The tenants had to climb out of the kitchen window to get out of the property. But thankfully, nobody's hurt." And you can tell by the photos here, kind of putting it all into perspective, the fire started in the garage where the tenant's Ford Excursion was parked. And you can see there that it was a pretty bad fire. The tires melted off the car, and within minutes, our property was essentially completely destroyed. So after getting the details, talking through everything, and ensuring our investors that everything was okay, essentially, nobody was hurt, we immediately contacted our insurance company. We began the claim process. We notified our investors of the troubling news, but also reassured them that we were adequately and properly insured, and that our insurance policy provided, for a reimbursement of loss of revenue, which essentially means that our rental income would be paid to us until the claim was finalized. And by the way, being insured for loss of rental income is critical, and we require it on all of the investments in our fund. So from there, we hired a public adjuster to handle the claim on our behalf. And for anyone not really familiar here, public adjusters are bound by the law to protect us, the property owners, so that not only are our best interests being met, but also really to ensure that we may receive the appropriate compensation for our claim. So, many think that your insurance company has your best interests in mind. I'll just say, that's up for debate. So for the next 3 months, I really worked day in and day out with our adjuster to finalize our claim and, provided our investors with many progress updates along the way. And in the end, the insurance company determined that our payout for the property damage would be $125,000. Meanwhile, our adjuster, fought them. He provided analysis showing repair cost over 2 times as much, over $250,000. So, keep in mind our total cost to purchase this duplex and rehab it was $94,000, and we ended up settling the claim at $198,000. So we really were able to turn a pretty tough situation into a positive outcome that provided significant profit to our investors. So now we had to determine what to do with the property. The insurance claim had been paid out, and essentially we had to make a decision here. And we provided our investors with a detailed cost-benefit analysis outlining several different options, and we ended up voting in favor of selling the property as is, which is what we did. We sold it for $9,000 to a local rehab company. And, I bring this story to you today just to kind of demonstrate the ability to react quickly and take efficient and effective action to remedy what you could see here was an unexpected and really critical situation. And it's just the way that we do business and really what we look for in all of our operating partners. So just to summarize, over the past 10 years, we've created and managed more than 40 real estate partnerships. We've bought, sold, and invested in over 100 properties across many different asset classes, including single-family rentals and flips, apartment communities, short-term vacation rentals, strip malls, vacant land, self-storage, student housing, mobile home parks, and even oil wells. My father and I today continue to work together regularly, maintaining our assets within our company. He is 70 years old and has slowed down a bit in the day-to-day operations, but through our firm and personally, we maintain actively well into 7 figures invested just into our 3 asset classes targeted for this fund. So you'll hear more from me in a few minutes as we get into the details of our assets, but I'll let Ryan jump in and share a bit more about his background while we're here.
Perfect. Thanks, Mark. So my background is all in the, or primarily in the investment management space. This is the 5th fund that I've managed, but before we get there, let's start at the beginning. When I was a senior at Cal Poly back in January 2007, I really wanted to get into real estate investing and real estate development. And so while I was still taking classes, I got my real estate license, since at that time, everybody believed real estate could only go up forever. And so I remember my first team meeting as a brand new agent, where the managing broker stands up and says, puzzled, home prices were flat this month. And I think everybody around the room kind of scratched their heads, wondering what that could possibly mean, right? Well, obviously the financial crisis ensued, and I never sold a single house. But instead, I took my finance degree into the investment management side. I worked through the financial crisis at LPL Financial, and then worked for a number of years at Bill Gross's PIMCO in Newport Beach. Through it all, I always wanted to get back into real estate. But I spent a series of years raising venture capital for tech startups and doing finance and accounting for software companies. And then after moving to Bend, Oregon, I became friends with Darren Powderly. And Darren had recently started an online real estate investing platform called CrowdStreet. I became an early employee of CrowdStreet, helping to raise capital for the first series of deals on their platform. And it was really here that I gained exposure to a lot of different real estate investments and deals and property types, and first started to really talk to a broad group of investors. So about 4 years ago, while I was at CrowdStreet, I was studying for the CFA program, and I became really passionate about monetary policy and macroeconomics. I know it's kind of geeky, right? But I was fascinated by reading financial history, especially how quantitative easing and low interest rates might play out. I was asking myself, okay, what would happen down the road? Either massive inflation or a devaluation of the dollar, or both. Central banks just couldn't print money forever without consequences, right? I believed another financial crisis, or at least a recession, was imminent. I studied financial crises from all over the world and researched multiple asset classes to come to the conclusion that owning and holding real assets that generate cash flow by meeting a basic human need is the best way to weather a recession. The likelihood of these assets going to zero was extremely low, and since shelter is a basic human need, people will pay for shelter even after they've stopped paying for many other things. I came away believing that lower cost housing, close to jobs, will most likely stay occupied and cash flow when times get tough. Even back then, it was my goal to start a fund that would own these assets and have the capability to perform and even really thrive during a recession. I really wanted to create the right investment strategy for a recession, and it's been with me ever since. While I was working on how to design this type of strategy, I left CrowdStreet and began managing a debt fund called Trueline Capital. It was a boutique friends and family fund when I joined, and we had started out with 7 investors and about $700,000 in capital. I helped to restructure that fund into Trueline Capital Fund 2, and we proceeded to scale it to over 170 investors and $20 million in capital in less than 3 years. We underwrote over 100 successful loans, totaling about $40 million in originations, and generated a 10.6% annual return to our investors during my tenure there, which for a debt fund is something I'm really proud of. While I was there, I always kept going back to my desire to create a fund positioned for a recession. I worked on a number of different fund strategies and asset allocations, but it really wasn't until I met Mark about a year ago that this concept started to really take shape. As Mark shared in his experience and background, he had the experience, the relationships in all these different asset classes, and in some very specific asset classes. And so combining that with my experience in managing funds, and then really our shared belief and desire to position capital for an upcoming correction, it created the perfect opportunity to bring this investment vehicle to fruition. Okay, so today, I know I'm not the only one feeling like a financial storm is on the horizon. Good investors often have good intuition, and I can't tell you how often I hear the statement, I'm growing more and more concerned about the potential for a market correction. And that's usually followed by the question, what types of investments are most likely to weather a financial storm? We believe now is the time to prepare for the next recession. We designed the recession-resistant fund to reduce risk and uncertainty through really any number of potential economic storms that could be looming over the horizon. Our fund combines 3 asset classes that we've been investing in for many years and have historically continued to perform during economic downturns. Okay, remember the intuitive investor I mentioned just a minute ago. There's a reason it feels like this cycle's gone on for a long time. When you stack up all the expansions in US history, where are we today? We're right here, right at number 2, 114 months and over 9 years in. So no wonder many investors have this intuitive sense that we're pretty long into the cycle. After 10 years of unprecedented growth and low volatility, 2018 saw volatility return to the stock markets. The bottom chart here shows volatility in this year at its highest level since 2009. Now, we also found this really interesting. This is a report that came out from Deutsche Bank last month, stating that 2018 year to date had been the worst year in history for global assets. They showed 89% of all assets all across the world are down for the year. That was as of November. The previous record was in 1920 when 84% of assets were down. And this report becomes even more staggering when you learn that last year, 2017, was the best year ever for global assets, where only 1% of assets were down for the year. I think the one asset that was down was the bond market in the Philippines. And so, we look at this and just say, clearly the market is telling us something. When we go beyond the stock market, we really see that households are under pressure. I think everyone understands this. Things are becoming more expensive. And it's not just luxury items, but healthcare, gas, bread. Consumer inflation is at a 6-year high, while inflation-adjusted wages over the last decade are totally stagnant and flat. And this trend means that the cost of living in the US is rising rapidly. The reality is many households have failed to benefit from the expansion over the last decade. And another point I want to mention now, and then we'll get into more later, is the United States is staring at a very serious affordable housing crisis. Consumer inflation shown here omits housing costs, which typically takes up more than a third of a household's income. Now, consider that over half of all workers in the US make less than $30,000 a year, and over 60% of Americans don't have enough savings to cover a $500 emergency. Clearly, households are under financial pressure. This is just another important indicator for us. Finally, the Fed is raising interest rates, which just acts like hitting the brakes on the economy. So maybe the intuitive investor is onto something. Of a panel of professional economic forecasters, half believe a recession is likely next year. So if we want to be savvy investors, what do? Well, we believe we start looking for assets that will hold value and continue to perform through a recession. And that's what we're doing in the Recession Resistant Fund.
Great, thanks, Ryan. As I mentioned earlier, my family and our firm has been investing in numerous real estate asset classes for over 10 years now. And we've selected our favorite asset classes for this fund. They're quite unique because they perform very well in a positive market, which we've all really experienced over the last decade or so. But they also have historically performed very well during downturns and recessions. We are experts in underwriting these assets. We've got the relationships to access the top deals and the discipline to say no if a last-minute red flag shows up. We will pass on the deal. We actually pass on the majority of the deals that we see. So let's quickly jump in. We'll start with mobile home parks, which is the first asset class for the fund. And Ryan had mentioned a minute ago that the United States is in an affordable housing crisis. Well, manufactured housing is the least expensive option available. And because of that, mobile home parks are counter-cyclical. Demand goes up for affordable housing in a recession. And, not only is demand going up, but supply is limited because zoning and development regulations often restrict new mobile home parks from being built and developed. And you may not know, but mobile home parks actually provide one of the highest rates of return across all real estate assets. The second asset class targeted for our fund is self-storage facilities. Self-storage remains stable during a volatile market. And the headline here is that at the peak of the 2008 financial crisis, self-storage REITs delivered a 5.1% positive return, while general REITs were down 38%. So imagine if you had held, only self-storage in 2008, the outcome would have been much different. But, the stability is really what we're targeting here. And there's several unique characteristics of self-storage that we'll dive into and cover in a bit more detail for the stability that we're seeking here. And the third asset class is apartment communities, specifically workforce housing, which also has a counter-cyclical element, as households tend to often reduce their cost of living by downsizing to apartments during difficult times. So, to expand on that, even in the most recent expansion, which we've all experienced, apartments have been in very high demand. Home ownership is at its lowest rate in over 53 years. And it's not just millennials. Every age group has seen a significant drop in ownership, including adults over 45. This group has actually seen a 60% increase in renting in the last decade. And That's a very interesting stat that keeps pointing back to the picture of growing demand. One last point on affordable multifamily communities is they're often very accessible to favorable financing and refinancing options. So we really like this chart here. It's got some pretty good trends that we want to share with you. And I want to emphasize something important here. You know, in the expansive market of the last decade, our three asset classes have seen the strongest net operating income growth when compared across, 10 different types of real estate, as you see here. And irrespective of a possible recession, this NOI growth is projected to continue. So to state it simply, we strongly believe that these are the best assets to be in for today's uncertain environment. So let's dive in. We'll spend about 6 or 7 minutes talking about each asset class in a little bit more detail. We'll start with mobile home parks. You can see one here on the screen that we recently invested in. But, years ago when we first started researching and analyzing mobile home parks as an investment option, we quickly learned that they provide some of the highest cash flow of any asset class. And we're further intrigued to learn that billionaire Sam Zell is one of the largest mobile home park owners in the country. At the same time, we also felt, some concerns, as many others do. We were worried about the quality of the parks. Do the residents take care of the property? Do they pay their rent? Are they even desirable places to live in? And we were worried also, what happens if there's a big storm and a strong gust of wind comes through? Can it just, blow the homes away? And yes, there are many parks out there that are run down. They're not well maintained. They're in undesirable locations, same as any other asset class. And we found that these undesirable parks tend to attract a more difficult resident base. And we prefer not to invest in parks that are in undesirable locations. We also found that there are many attractive parks in great locations. And these communities have a strong pride of ownership amongst the residents. A lot of times the majority of the homes are actually owned by the residents, who then pay the lot rent to us, the mobile home park owners. These types of, attractive and desirable parks are really where we focus our investment dollars. In addition, we learned, that since the 1970s, mobile homes have been regulated by the government, HUD, which implemented tie-down requirements for mobile homes. And for those of you not familiar, tie-downs are heavy-duty straps and anchoring systems that are installed on various parts of mobile homes. And we were comforted knowing that there's government regulations and requirements that have continued to evolve over the years that are put in place to help protect mobile homes from wind forces. Now, another important point we learned over the years is that mobile homes are not really mobile. It costs between $5,000 to $10,000 to move a mobile home, and this greatly restricts the homeowner's ability to relocate. And it makes sense if you think about it. The lot rent, it may only be a few $100s a month. So to move their home is often cost prohibitive. Recently, Sun Communities, which is a publicly traded REIT that owns over 120,000 mobile homes in the U.S., they reported that their average resident in their community stays for 12 years, and that the average mobile home stays in their parks for 50 years. So we soon grew more and more comfortable with the asset class. We came to realize that many of our initial concerns could be mitigated with proper due diligence and really careful asset selection. A couple unique business model points I want to mention here. The majority of the parks that we're targeting for investment rent the land to the residents, who often own the actual home. So this results, again, in a pride of ownership and lower maintenance cost for us, the park owners. And that low expense ratio is one attractive investment characteristic that really results in high profit margins and consistent cash flow. In addition, there's several tax benefits. The majority of a park's value is comprised of land improvements. Think about the roads and the utility lines, for example. And these can be depreciated at an accelerated schedule, typically averaging 15 years. And the result is, a maximized after-tax net proceed to investors, which is something that we also find very attractive about mobile home parks. Real quick, MSN Money ran a recent article agreeing with our model that mobile home parks are counter-cyclical. And what they did, they tracked mobile home park publicly traded REITs just in October, 2 months ago, while the S&P, saw really significant declines in volatility. These REITs remained stable. And there's a developing, long-term trend here that I like to share regarding baby boomers. We'll just run through it quickly. But it affects the demand for manufacturing housing in a very positive way. But it makes sense. 1 in 3 baby boomers have zero money saved for retirement, and 6 in 10 have less than $10,000. In addition, the average baby boomer has $99,000 in debt. So boomers are really definitely experiencing the impact of the affordable housing crisis, and they're generating significant demand for manufactured homes. And what you can see on this chart here is the shipments of manufactured homes for the past 8 or 9 years. And it's really not a fluke that manufactured home sales started rising in 2013. That's actually the first year that boomers started to retire. So bringing it all together, in summary, we're very attracted and continue to grow more attracted to investments in mobile home parks. They're counter-cyclical, recession-resistant. They provide great profit margins and cash flow with a very strong upside potential. The homes are really not mobile. That results in high resident retention. And when you add in, the equity benefits that we went there, the unique tax benefits that we just mentioned, the increasing demand, you can really start to see why we believe this is the best asset to be in right now. And we are targeting mobile home parks to encompass roughly 50% of our fund portfolio. Let's look at a quick example. This is a case study of a real investment that we participated in. We began investing with a mobile home park operating partner over 6 years ago. And this is a summary of that specific investment, which consisted of an ownership in 15 mobile home parks across 6 states. This portfolio provided us with consistent, predictable cash flow with a strong upside. And that's really what we're targeting for our fund, something very similar to this. We've got a few investments already lined up to be funded in the next 3 to 6 weeks. But this investment sold in 2018 as part of a larger portfolio sale of $344 million of mobile home parks that were sold to a private real estate equity group. And we earned over 13% IRR and 80% return on our investment. Okay, let's spend a few more minutes talking about self-storage. So remember, when we said self-storage is stable in a recession, here's really why. Self-storage is very flexible. It can be adjusted quickly to the market with incentives like a free month rent or a free moving truck, which really helps attract tenants to fill vacancies. Once tenants are acquired, they are extremely sticky, which is a very big characteristic that we are looking for. One of our operating partners recently noted that their average tenancy is 2.7 years. And recently published information shows, nationwide that 40% of tenants stay more than 2 years in self-storage. So it really makes sense, but nobody wants to go move their couch from one storage facility to another on a Saturday just to save a few bucks a month. And because contracts are all month to month, rental rates can be raised on a 30-day notice. And further, the market is huge. The U.S. economy, has and continues to rely very heavily on consumer spending, which in recent years has contributed to over 70% of U.S. GDP. We all keep continuing to buy things, and that trend doesn't look like it's going to change. And with that comes the need for space to store belongings. Almost every single American will use self-storage during their lifetime. And recently it was reported that 1 out of 11 Americans pays over $90 a month for space to store their belongings. So we mentioned the stability and the performance, which is one of the key variables of storage and why we selected the asset class for our fund. But there's a few other quick advantages I'll run through. Very low overhead. You can operate a self-storage facility, even 1,000-unit facility with 1 or 2 full-time staff. There's very low utilities when you think about the lack of plumbing and electric and gas throughout the facilities, which results in simple maintenance and lower operating costs. And those are some of the few characteristics that we like about self-storage. Now, I want to note a recent trend in the industry. Self-storage went through a period post-recession where there was a significant lack of supply to meet the demand. And you can see that on this chart. This is new self-storage construction spending year over year. It's actually shown by month. But generally speaking, what you see in the earlier years on the chart is that there's a lack of supply, and that's starting to became offset for the past few years by an increase in building and construction of new storage units across the country. This increase in supply is a factor we've been looking at and we're monitoring very closely when selecting a self-storage facility for investment, because high levels of new development can put pressure on rental rates and occupancy. So most recently, you can see on the bullet points here, the trend shows that self-storage construction spending has actually been declining, which suggests that construction has peaked. And what we're doing, we're taking this data and continuing to monitor it, and we're proceeding very cautiously for the next year or so as the supply and demand for storage units will begin to balance out. And the number of new units coming online, as you can see in the bullet points again, is expected to drop by over 50%. And fewer than 100,000 units annually are forecasted for 2020 and 2021. And we are projecting and estimating that self-storage will be the minority asset of our fund, with roughly 10 to 20% of our portfolio. Okay, let's run through an example. This is another investment example. We had been investing in self-storage with this specific operating partner for about 6 years now. And they are a national developer and asset manager with over 45 years of experience just in self-storage. They're estimated to be, the 28th largest operator of self-storage assets in the US, with over 29,000 total spaces. Their focus is primarily on value add, and that's in alignment with our focus as well. And this example shows you a pretty good value opportunity. We were able to increase physical occupancy and gross rental income, and took a 517 unit facility in Florida, bought a few years ago for $7.5 million, and we sold it earlier this year for $8.7 million, which resulted in a 25% average annual return to investors. Let's dive in and talk about apartments, spend another 6 or 7 minutes, which is our third recession-resistant asset, specifically workforce apartment communities. Workforce housing is affordable to workers and close to their jobs. It's rental housing that can be reasonably afforded by the moderate to middle income local population. So when we look at the overall housing market, home ownership peaked in 2007, and it's now at its lowest levels in over 50 years. And many of the people that are choosing not to buy homes are living in apartments. Apartment demand has surged, and this trend is only projected to continue. And to put that into perspective, on a national level, 4.6 million new apartments are needed over the next 12 years just to replace the decaying stock of existing apartments. So the rate of new apartment developments would really need to almost double to catch up with the demand. We focus again specifically on value add, where we're increasing operating efficiencies and the bottom line, or the net operating income. But I want to note, we're not going to be focusing on construction or development projects or short-term rental investments that don't produce predictable current income and cash flow. We'll also not be investing in recently built apartments. You know, the newer construction tends to create more expensive housing, primarily due to high construction costs. And higher end apartments are often the first assets to reduce their rental rates during an economic downturn. So we will not be investing in recently built apartments. Let's dive in and look at a couple examples of apartments that we have sourced for the fund and will continue to source. So this is a 284 unit apartment community that we just invested in last week. It's the first apartment community for our fund. It's in Austin, Texas, just 7 miles from downtown, and it has a great value add component. 59 of the units have already been renovated by the previous owners, and they are on average providing $200 more per month per unit than the non-renovated units. So the play here is to come in, renovate about 150 or so more units and the exterior grounds over the next few years to increase the net operating income that the property produces. We want to take it from $2 million to roughly $3.4 million. And the property is already 94% occupied, generating a strong positive income. And we're really excited to have an ownership position in Austin, Texas, which is one of the fastest growing cities in the country. This is another investment example that we invested in a few years ago. It's in Kansas City, Missouri. The property was built in 1989. It includes 17 buildings on over 8 acres, right next to an 18-acre lake. And performance-wise, this investment distributions through earlier this year yielded a 13.5% annualized return. This is a really good example of a value-add investment, essentially by our operating partner who renovated the property and the units and increased the value by over $10 million in just a few years. Take a look at another quick example. This is another investment that we are still an equity owner in. It's about mid-2016 we started investing in this property, and it's in Richmond, Virginia. Again, the property was recently appraised and refinanced, and the value-add business plan has resulted in a 13% increase in value in just 2 years. So we're really excited to continue investing in very similar apartment communities.
Awesome, great. Okay. Well, bringing it all together on these 3 assets into the recession-resistant fund, really we're combining these into a portfolio for passive investors that generates current income and a predictable and stable cash flow. The fund will invest across a diversified number of best-in-class real estate operators that acquire, improve, optimize, and manage mobile home parks, self-storage facilities, and apartment communities. Some of the investments we make will be into portfolios of properties, and so we'll even be able to provide additional and significant diversification there. So diversifying capital across a large number of investments is a great way to reduce risk. We can reduce geographic risk, operator risk, strategy risk, and sector risk through our fund structure. And then lastly, one of the most attractive benefits of our fund is the ability to combine different assets to achieve consistent cash flow and high upside. For example, if we invest in a property with a lower yield, but which has the potential for a really big exit after fixing a problem, and we combine that with a property that has a higher yield today, but a lower exit, we're able to create a smooth passive portfolio for our investors. And this strategic fund design is really advantageous. Lastly, one of the big values we bring to investors in the fund is the ability to access these deals. These opportunities are often exclusive. They have high investment minimums, and we know these operators, and we're sometimes able to negotiate more favorable terms than an individual investor would. Okay, we've outlined the 6 main investment objectives for the fund. The first one is capital preservation with downside protection. That's exactly what you would expect in a recession-resistant fund. Predictable cash flow with upside potential. High risk-adjusted returns with wealth creation. That's kind of a nod to all the value-add business plans we've been talking about. A superior hedge against inflation because we're owning real assets. So this is kind of what I talked about earlier. But if you think of it this way, if inflation rises, housing prices and rental income will also rise. So that provides our fund with a strong hedge against inflation. Okay, favorable tax benefits that we mentioned, especially related to mobile home parks. And then lastly, diversification across regions, operators, and assets.
Okay, thanks, Ryan. Let's dive in and talk about the investment offering. We have two investment options depending on the investment size, Class A and Class B shares. Class A has a $250,000 minimum and Class B a $50,000 minimum. And both share classes have an 8% preferred return. And preferred return essentially means that investors earn an 8% return annually on their money before there are any profit splits with management. So it really acts like a downside protector for investors. It really incentivizes management, us, to perform and choose the right assets because management split isn't earned until the preferred return is paid to investors. And it's a critical component that I, as an investor, always look for. Additionally, the preferred return accrues each year. And so in the early years, if cash flow is lower than the preferred return, the investors will catch up the following year. Once the preferred return is achieved, remaining distributable cash is split. Class B earns 70% of the profits above the preferred return, and Class A 80%. And our targeted investor returns are in the low to mid-teens for IRR and high teens to 20s for average annual ROI. We're targeting an equity multiple of 2, which means we are working to double investors' money over the life of the fund. And for a limited time, we've decided to offer something special for early investors, which we call the founder shares. And essentially what that is it means that the first $2 million of investment into the fund will receive a higher preferred return of either 9 or 10% for the entire life of the fund. Now, we kind of quickly mentioned this earlier in the presentation, but we've already filled over 60% of our founder shares. We anticipate the remainder to fill up quickly after this presentation. So if you find our business model aligns with your investment strategy and you're considering an investment, the next step is just to reach out to us, email, phone, and just let us know what questions you may have, and we can share with you our PPM and subscription agreement. And the real reason we're offering the founder shares is because speed to market is really important to us. We've already begun investing, and we have already targeted our next few investments, and we're excited to be able to deploy capital in the next 30 days. Our management fee is 2%, which is calculated based on capital raised. And there's a one-time acquisition and disposition fee of 1%. Our overall investment term is 5 to 10 years. So we do expect that our assets will experience refinances, and some may sell in as early as usually year 3. So we expect to begin to return a portion of investor capital as soon as year 3, and usually from year 3 to 5 is how these play out. On the cash flow side, we plan to make investor distributions quarterly, and we are projecting annual cash flows to ramp up to 10% after the first few years. Now, we're planning to invest in 7 to 10 assets, but as we mentioned through the presentation, several of these assets are portfolios of multiple properties. They're not just single properties. So overall, we expect the fund to consist of over 40 properties located in over a dozen states, and that's really our goal here, is to achieve significant diversification. All right, well, this is our summary slide. We really appreciate everyone taking the time today to consider our fund. As an investor, I truly believe this is really an important way to prepare for tumultuous markets. I had personally been looking for an investment like this for quite some time, and I'm very happy and excited to be able to provide it and create it alongside with Ryan. And again, thanks again for jumping on the webinar with us today. We know that it's a busy time for everybody, and we appreciate you joining us.
Great, awesome. Well, we're happy to take a few more minutes and talk through any questions that anybody on the webinar has live. We're also happy to follow up with those questions over email or anything. And to start, we can answer a couple of questions that we've kind of gotten along the side. Is the project or is the fund open only to accredited investors? Yes, it is. This is probably many investors are familiar with this. It's a 506c offering, which means it's open only to accredited investors. Investors will have to provide a verification when they invest, either provided by their CPA or by a Verify Investor or another vendor like that.
Okay, good. We got a question earlier. Someone asked, why are some of the annual cash projections lower than the preferred return? Yeah, it's a good question. It's likely that during the first few years, while each of our value add assets are taking place, repositioning the assets, increasing NOI, that the amount of cash flow available for distribution will be lower than the preferred return. So it's pretty common for value add strategy to see that. But investors' preferred return accrues annually. So any balance is carried over to the following year. Excuse me.
Okay, great. Can I invest through an IRA retirement account? Yeah, that's a common question that we get. Yes, you can. Matter of fact, we believe this is a great investment for self-directed IRAs. There's several different what's called custodians that we've worked with. And we can help anybody that wants to invest that way set that up. Usually the custodian just has their own form that we can help you fill out along with the subscription agreement. So, okay, another question here. When are distributions likely to begin?
Yeah, good question. Our goal is to begin distributions to investors at the conclusion of Q2 2019, if not earlier. So, excuse me, we're really projecting that to be very feasible, and we're excited to start doing cash distributions within the first couple quarters of the fund. And then we did get one more question. Somebody asked about reporting. What type of reporting will they receive? Essentially, what we do is we furnish investors with a fund update quarterly that provides updates on activities of the fund, investments in the fund, operations, and performance. And also annually, investors will receive a K-1 for tax reporting.
Okay. Great. Awesome. Well, thanks, everybody. Appreciate your time. I hope everybody has a great holiday coming up and a good rest of your December. Please follow up with us over email if you're eager. If you have any other follow-up questions or over the phone, we're happy to connect. We'll also be sending out the link to both this recording for this webinar to everybody that had signed up, even those that couldn't make it today. And we'll send these slides along on the presentation. We know we went through a lot of material, so if there's anything you want to take a second look at, you'll have those with you shortly. So great. Thank you, everybody. And we'll be connecting with you each soon. Thanks a lot. Bye.
Done and done.
I did it.